Welcome to our cross-reference tutorial on managing banking. Today, we'll guide you through the process of customizing your bank accounts and the functionality and features available to cater for your business needs within the cross-reference platform. Each bank account in cross-reference is an entry in the assets section of the chart of accounts within cash on hand for bank accounts. In the account edit screen, the account category should be set to bank for these accounts. Credit cards are in the liabilities section within creditors section. The category type for these accounts should be set to credit card in the account edit screen. To see all the banking related accounts listed, navigate to Finance in the menu and select Banking from the list. On the left side of this screen, each bank account is listed with a balance at the time of the chosen end date. The right side shows the transactions from the start date until the end date for the highlighted account, so the user can see how the account balance was accumulated. The total funds moved into and out of all accounts are displayed at the bottom, so the collective financial movement of all accounts can be ascertained. In the top section, if you click on the Chart button, a screen with a chart of monthly account movements for the selected year will be shown with income and expenses displayed as bar charts. There is also an area chart reflecting the accumulation of funds from income exceeding expenses. This is a banking cash flow chart that displays the health of the business bank account. There is, however, a distinction between a bank account that looks good and a business that is doing well, because cash-based reporting does not reflect pending income or liabilities. So a more accurate reflection of how a business is doing requires the general cash flow chart, which is populated on an accrual basis. You might ask why there are two cash flow representations and why they don't necessarily match in totals. General cash flow provides a detailed view of financial performance over time, reflecting all earned revenue and incurred expenses, regardless of payment timing. This is useful for understanding profitability and managing long-term financial health. Banking cash flow offers a real-time snapshot of actual cash on hand, which is crucial for managing day-to-day operations and ensuring liquidity. It operates on a cash accounting basis, meaning it only records transactions when the money physically enters or leaves your bank account. Since this screen records transactions only when cash is exchanged, it does not include any pending receivables or payables. For example, if you have issued an invoice but the payment hasn't been received yet, it won't appear in the banking cash flow. Businesses often need to look at finances from both accrual and cash perspectives. Accrual accounting helps with understanding true financial performance, while cash accounting helps with cash flow management. Having both views allows for more informed decision-making. For example, a business might be profitable on an accrual basis, but facing cash flow issues on a cash basis, highlighting the need for different strategies to address each scenario. Including both the general cash flow and banking cash flow screens provides significant benefit to users by providing a holistic view of their financial situation. These screens can empower users to make better financial decisions and manage their businesses more effectively. One of the first financial transactions a business usually requires is a capital injection. This is reasonably straightforward in cross-reference, even if the user is not well versed in journal entries, because the system does it for you. Simply click on the capital injection button, select an equity account and a bank account, adding a note and an amount. When you click Add Capital, the required journal entry will be made, and the chart of accounts will reflect this change. The bank account will reflect the funds injected into the business. The chart of accounts will reflect the owner equity being updated, and the general ledger will reflect the required entries. In a similar fashion, another common banking task is the transfer of funds from one account to another. Simply click on the Bank Transfer button, select the From and To accounts, then add a note and an amount. When the transfer button is clicked, the funds will be moved into the target account and removed from the source account. Please note, when we say the funds will be moved, performing such functions in the accounting system is merely recording actions that were performed in the real world and not actually moving physical funds. The Drawings and Dividends buttons in cross-reference allow you to manage and record the withdrawal of funds by owners or shareholders from the business. While these functions operate similarly by reducing the available equity in the business, their implications can vary significantly depending on your business structure and financial strategy. Typically used in sole proprietorships and partnerships, Drawings refer to the money taken out of the business by its owners for personal use. This does not constitute a salary or wage, but rather a distribution of the profits that the business has earned. Usually associated with corporations, dividends are distributions of a portion of the company's earnings to its shareholders. Dividends can be issued as cash payments or additional shares of stock. This function in cross-reference facilitates cash payment dividends. It is advisable to consult a qualified accountant before using these functions because drawings and dividends are treated differently under tax laws. Both drawings and dividends reduce the equity in the business, but affect financial statements differently. Deciding when and how much to draw or distribute as dividends requires careful planning to ensure that the business maintains sufficient working capital for operations and growth. By consulting with an accountant, you can ensure that the use of the drawings and dividends functions aligns with your business's financial strategy and complies with relevant tax laws and regulations. Proper guidance will help you avoid potential legal and financial pitfalls, optimize tax benefits, and support the sustainable growth of your business. In cross-reference, bank reconciliation is one of the most crucial functions for maintaining accurate financial records. This process involves comparing your internal financial records with the corresponding entries on your bank statements to ensure consistency and accuracy. By reconciling your bank accounts regularly, you can identify and correct errors, such as duplicate entries or omissions, ensuring your financial statements are accurate and reliable. This process helps maintain the integrity of your financial data. Reconciled bank accounts demonstrate robust financial management, which is often looked for during audits. Reconciliations help you understand trends in income and expenditure, providing insights into your business's financial health. The reconciliation process in cross-reference involves ticking off each transaction as it matches your bank statement. This ensures that you personally review and verify every transaction, so you stay actively involved in your financial monitoring. This hands-on approach helps you quickly catch and address issues like unauthorized subscriptions or unexpected charges. Cross-reference allows you to store PDF copies of your bank statements within the software. This feature guarantees that you always have access to your financial records, even if your bank account is closed or you lose access to online banking. This archival benefit ensures that your financial history is always available for audits, tax filings, or financial reviews. To create a bank reconciliation, click on the Bank Reconciliation button in the banking screen. The list of existing bank recs is displayed here, and to make a new one, please select an account from the drop-down and then click the Add New Reconciliation button. The bank statement you have available can be attached to this bank rec for future reference. On the bank statement, set the from and to dates to match the statement dates. Also, the opening and closing balance should be copied from the statement. Next, save the bank reconciliation and it should appear in the list. Now click the Edit button in the Action column to edit the bank reconciliation and the transactions will appear. Check off each transaction against the bank statement. When all transactions are selected, the unreconciled amount should be 0. If there is any discrepancy, it may indicate a missing, duplicated, or incorrect transaction. Resolve these discrepancies to balance the reconciliation. Once all discrepancies are resolved and the reconciliation balances, the process is complete. Ensure that bank reconciliations are performed for each account held by the business. A common inquiry is how to enter bank fees. Create a contact with the name of the bank and use supplier transactions to record bank fees. This helps track the true cost of banking across multiple accounts. If transaction dates are slightly off due to processing delays, you can edit the payment dates. This can be done by going to the Customer Edit screen and adjusting the payment date. This is particularly useful when dates are near a reconciliation cutoff and may affect the next reconciliation period. The banking screen in cross-reference, while straightforward, integrates with various aspects of your financial management system. This guide aims to clarify its purpose and functionality, ensuring you can effectively manage banking transactions and maintain accurate financial records. By following these steps and tips, you can keep your business's financial situation at the forefront of your decision-making process. Thank you for joining us today. Remember, we're here to help you make the most of our platform. If you have any questions, don't hesitate to reach out to us using the About screen in cross-reference.